Hi everyone! I've done a few videos now on inflation, why it's low at the moment, why it's increasing, but what should you invest in if inflation takes hold? After all, according to Warren Buffett, inflation is the biggest wealth destroyer known to man, and worse still, it happens subtly, relentlessly. £100 in cash 80 years ago is now only worth £1.77. Or put it another way, money has lost over 98% of its value over the average lifetime. This is much more than, say, inheritance tax, so in this video we'll look at some things that escape the grips of inflation. I'm Anthony, and as always, we're talking money. Okay, so if inflation erodes the value of money over time, we need assets or investments that keep pace and ideally exceed the inflation rate. This doesn't necessarily mean that income or yield from an investment should be higher than the inflation rate, but the total return of capital and yield should exceed inflation. So the first item on my list has no yield at all, merely capital appreciation, and not surprisingly, many people look to gold as the typical inflation hedge. The reason for this is that a depreciating currency like the dollar, and let's face it, inflation can almost be defined as a depreciating currency, makes gold and other commodities look cheaper, i.e. $1,000 to buy an ounce of gold in the future is going to be much cheaper than $1,000 in today's money if inflation is high. If the price is cheaper, then demand for it goes up. As demand increases against a relatively fixed supply, the price goes up. Hey presto, the price goes up at the same rate as the depreciation in the currency in which gold is sold, i.e. dollars. If only things were that simple though. Against a backdrop of a depreciating currency, central banks have the ability to make the currency look more attractive by jacking up interest rates, for example. Also, gold reserves held by central banks can be released, and this alters the price of gold by altering the supply. This decision to be made by an investor is whether it may be better to get a return on a currency or stick with a potential capital appreciation on gold. The higher the yield on a currency, the less attractive it becomes holding a nil-yielding asset like gold. So there becomes an inbuilt balancing system to limit how much gold appreciates against the dollar. Here's the graph that shows the price of gold against the dollar inflation rate. The yellow line is the price of gold and the red line is the inflation rate. In the 1970s, in high inflation times, the gold price does indeed rise in line with inflation, but there are decades, most notably from 2000, that the gold price has decoupled from the inflation rate. Gold as a hedge against inflation may be more down to a myth than reality. But put some thoughts in the comment sections below, because you might well have your own view on this. So gold, while often seen as a safe haven in times of economic strife, may not always be the best hedge against inflation. But as most commentators suggest, it may be worth considering holding a small part of your portfolio in gold, whether in physical gold or as an exchange-traded commodity. The latter allows you to invest in gold, but with a much lower spread, and of course, without the risk of having it stuffed under your mattress. Now, gold is a commodity, but commodities in general are often seen as a separate class to gold, and they include things like grain, precious metals, electricity, oil, beef, orange juice, and natural gas. Now, commodities have an almost unique relationship with inflation in that they often move in the direction that future inflation takes. One reason why people think that we are headed for rises in inflation now is that these commodities have all seen substantial increases in price over the last 6 months. These price increases feed into goods and services that rely on these commodities, and eventually the prices are passed on to the final consumer in the form of inflation. So it stands to reason that if you expect inflation to continue to go up in the future, then this can be preempted by a rise in commodities too. But just remember that increases in commodities often cause and precede inflation. So investing in commodities in anticipation of inflation is a bit like saying that I run quickly because a tiger is chasing me. So if I run quickly, a tiger will chase me. Well, it may happen, but then again, it may not. In other words, inflation follows commodities rather than inflation leading commodities. But let me know your thoughts on this, as it's very far from being clear-cut. Next on the list is property. This can take many forms, such as direct investment into houses, flats, HMOs, offices, retail, garage, holiday lets or holiday homes, etc. From personal experience, this is not a totally passive form of income. If especially you have tenants that need chasing for money or something goes wrong, but property does have the added benefit of generating a yield in addition to any capital gain. So total return is not dependent on just capital. As for the protection against inflation, some sectors do better than others, and the return is dependent on other factors such as interest rates and therefore mortgage rates, taxation, stamp duty, etc., or business rates and other government legislation changes. If you didn't want to invest directly, you can always invest in companies that do, such as building firms, some service companies that supply the industry, such as the energy or electrical sector. But one really popular method of getting exposure to property is via real estate investment trusts that own and operate properties, such as the Vanguard Real Estate ETF. The reason why property is such a good hedge against inflation is that rents tend to rise in line with inflation, as too does the value of the asset. The risk to this strategy is what happens to interest rates. Property, like shares, are a risk asset, and if you get a relatively low risk return on government bonds like US Treasuries, then the appeal of higher risk assets tend to go down, and hence the price demanded also goes down to push up those yields further. The next asset on my list is the index trackers like the SP 500 tracker, again available from, say, Vanguard. I only mentioned them because they are a very low cost provider and they're popular too. The conventional wisdom with the S&P 500 is that companies that are reliant on capital-intensive industries don't tend to do so well in times of inflation, whereas technology and services that don't need much capital tend to do much better. The S&P 500 has more technology, about 35%, than most other indexes. But not surprisingly, investing in a broad spectrum of risk assets like shares is not without considerable risk. Like other assets already mentioned, if interest rates go up, the appeal of those shares goes down. But that said, some shares do well, which leads me neatly onto the next item on my list, which is specific shares rather than index trackers. Not all shares perform the same in times of inflation. A study by Brian Belsky, who's the chief investment strategist at BMO Capital Markets, took a detailed look into which sectors did best in inflation and came up with the following conclusions. The energy sector, oil and fuel, electrical equipment and mining sectors did best, whereas construction materials, retail, pharmaceutical, food producers and household products did the worst. This is a little counterintuitive to me, as you'd expect some shares that are going to be in demand no matter what, and industries that have some control over their pricing power would do well. For this reason, I'm surprised that pharmaceuticals are on this list. And also, I've got a sort of hefty proportion of my own portfolio in this sector, so I'm a little bit worried too. Now, inflation traditionally wrecks the value of fixed income assets like bonds, because fixed income is worth less in future years if inflation has eroded its worth. For this reason, bond prices are very sensitive to inflation worries and is the main reason why bonds have fallen substantially over the last 6 months, pushing yields up. However, you can invest in inflation-linked bonds, and in America you have the Treasury Inflation Protected Securities too, or TIPS for short, which are specifically designed to protect against inflation. Typically, these assets pay out a fixed income twice a year, but the principal underlying value changes with inflation, and so the total return rises along with inflation. These are low risk, but as with all low risk assets, the return is not that high either, but at least you know you're not going to lose money either. Now, a final note on my last category for trying to protect against inflation is cryptocurrencies. Now, they've often been cited as a replacement to gold, especially Bitcoin, that, like gold, has a somewhat limited supply. A maximum of 21 million Bitcoins has led some to say that it's immune to the depreciation that fiat currencies like the dollar or the pound are subject to every time a central bank issues more currency. Now, while this part might be true, it's in my humble opinion that so many factors unrelated to inflation affect the price of Bitcoin and other cryptocurrencies that make it largely irrelevant as a hedge against inflation specifically. With other assets that I've listed in this video, there is an arguable link between inflation and the price movement of the asset. With Bitcoin, however, where price movements swing wildly on the issue of a tweet from an individual, say, or from an article on Reddit, or the next clampdown by governments in the form of regulation, its price direction is influenced by factors way beyond what happens to the latest inflation figures. By all means, have exposure to cryptos as a way to diversify a portfolio, but perhaps don't rely on it to protect you against inflation. As you can see from this graph, Bitcoin has been a pretty lousy protection against inflation by going up when inflation is low and going down when inflation has been increasing, precisely the opposite of what we're trying to achieve here. However, before we all rush in and buy gold, property, energy shares, etc., times of high inflation are certainly not guaranteed. The Federal Reserve and the Bank of England, the US bond markets, and indeed commentators like Brian Belsky put doubt onto whether the recent spikes in inflation will translate into anything more sinister or long term. Indeed, the current increases in inflation can be put down to a possible demand shock as a result of pandemic lockdown relaxation, where prices are merely adjusting to short-term supply issues. Inflation could just as easily come down over the next 12 months, which is why it's important to diversify investments so we don't have overexposure to any one particular investment prediction. Nobody knows what's going to happen, I certainly don't, but one thing I can suggest is that whether we're in for times of high inflation or low inflation, one of the worst asset classes is cash. Real returns on cash have been negative for a long time now, with interest rates on savings being substantially lower than the current inflation rates. This just means that cash is worth just a little bit less every month. Think of inflation in this context as a wealth tax, currently at about 2%. Nobody wants that, so whatever your expectation of inflation, cash is an asset class that is guaranteed to lose your wealth. So while it might be prudent to have some in your portfolio, invest the rest wisely. Now, in terms of how much cash you should have, that's really up for debate and maybe subject to another video. Let me know if you want me to do another video on that. But there is a rule that says that if you wake up at 3 o'clock in the morning worrying about how much cash you've got, then that's probably a good indication that you haven't got enough. But anyway, we'll come on to that perhaps in another video. Anyway, that's my take on how to beat inflation. There's quite a few asset classes that we've discussed in this video. I'm sure you may have some views too, and if so, put them in the comments section. I'll be intrigued to listen to them. If you haven't done so already and you like the video, I'll be so grateful if you could hit the thumbs up button and subscribe if you haven't done so already. I'm Anthony. Here we're always talking money. I'll catch you in the next video, but until then, bye for now.